All right, let's dive into a really fascinating case study today, a company called Farmer Mac. Its stock has been on an absolute roller coaster lately, and that kind of volatility, it gets a lot of investors very interested. So, this all boils down to one big question, right? Is Farmer Mac a hidden bargain, just waiting for a smart investor to pick it up? Or is it a classic value trap? The kind of stock that looks cheap on the surface but is actually a minefield? To find out, we need a standard, a reliable test. And to get to the bottom of this, we're not just going to crunch random numbers. Nope. We are going to use a very specific, and I mean very strict lens. Warren Buffett's #1 most important principle for investing. And that principle is summed up in one word: predictability. Does this company have earnings that are stable, that are understandable, and most importantly, that are predictable? That's the whole test. So every good investigation starts with a clue, doesn't it? A little crack in the perfect story. We're going to call this one the cockroach in the kitchen. And this first clue popped up right where you'd expect, in the company's latest earnings report. And here it is. Bam! On February 19th, 2026, Farmer Mac dropped its fourth quarter numbers. The market was looking for about $4.57 a share. What they got was $3.66. That is a massive 20% miss. A number like that isn't just a tiny stumble, it's a genuine shock to the system. So, naturally, everyone's asking, what happened? Well, management pointed to a $16 million loan loss provision and basically said, hey, these were just some isolated borrower-specific credit events. Their way of saying, don't worry, nothing to see here. It's just a couple of one-off problems, not a bigger trend.
But this is where that Buffett lens becomes so important. See, he has this famous saying for exactly this kind of situation. There is never just one cockroach in the kitchen. And what he means is when you spot one problem, especially a credit problem like this, it is almost never truly isolated. It's usually the first sign of a much, much bigger issue lurking underneath.
And that one quote, it just forces you to pull back, right? To zoom out and ask, is this really just one cockroach? Or are we starting to see cracks in the entire foundation of this business? And to answer that, we have to look at the economic world of their #1 customer, the American farmer. And man, when you look at the data, it is pretty sobering. This is straight from the USDA. Their forecast for this year projects that a full 50% of all U.S. farm producers will be unprofitable. I mean, just let that sink in. Half? That's the worst it's been since 2020. This is exactly the kind of storm cloud a Buffett-style investor is always watching for on the horizon. Okay, so why is that such a huge deal for Farmer Mac? Well, it's simple, really. Their loans, they're all backed by farmland. And if you look at history, whenever there's a big, prolonged downturn in farming, the value of that land, the collateral, it almost always follows farm income right on down. If the collateral gets weaker, the whole loan book gets a lot riskier. And what does that do? It eats away at one of the most sacred ideas in value investing, the margin of safety. Just think of it like a cushion, right? It's the buffer between what a business is actually worth and the price you pay for it. When the whole industry is struggling and the collateral is getting weaker, that cushion just shrinks. It leaves you with zero room for error. And here's the kicker. Farmer Mac is what's known as a spread-based business. They don't sell a product where they can just hike the price. They make their money on this razor-thin margin between what it costs them to borrow money and what they can charge farmers. So they have zero pricing power. They can't just say, oh, defaults are up, so we're going to charge everyone more. No way. Their profits are incredibly vulnerable if any more of those cockroaches start crawling out of the woodwork. Okay, so things are looking pretty grim, right? The case against the company is starting to look really solid. And then, management does something really puzzling. A move that seems to fly in the face of all these warning signs we're seeing. An unexpected payout. Get this, just days after dropping that bombshell of an earnings miss, the one caused by credit problems, they go and raise the annual dividend. And not just by a tiny bit. They bumped it up 7% to $1.60 per share. So, what in the world is going on here? How are we supposed to read this? Well, you've got two schools of thought. The bulls, the optimists, they'll say, see, this is a sign of confidence. Management is telling us the problems are just a blip and they're rewarding us shareholders. But the skeptic's view is a little different. They might ask, or is this just an attempt to slap some paint on a crumbling wall? A way to prop up the stock price and distract us from what's really going on?
And if we put our strict Buffett hat back on, this is a huge red flag because the truly great fortress-like companies, they do the exact opposite. When they see storm clouds gathering, they hoard cash. They build up the fortress walls. They don't start handing out more money. So raising a dividend while you're seeing credit stress, that doesn't scream strength. It kind of screams questionable decision-making. All right, we've got the earnings miss, we've got the gloomy industry forecast, we've got that confusing dividend hike. We've laid out all the clues. It is time to put it all together and deliver the final verdict.
And there's really only one Buffett quote that matters here. Price is what you pay, value is what you get. Right now, Farmer Mac's stock trades for about 8.5 times earnings. On the surface, that price looks cheap. But to figure out the value, we have to weigh the risks.
Okay, so let's build the equation. Piece number 1, credit risk. This isn't some theoretical thing. We saw it blow a 20% hole in their earnings, and it's being driven by a downturn that's hitting half their customers. That's real. To that, you have to add a risk that's just part of their DNA. Political risk. Let's not forget, this is a government-sponsored enterprise. Its destiny is always going to be tied, at least partly, to the whims of Washington, D.C. So what happens when you take that very real, very present credit risk and you add it to that constant, underlying political risk? Well, you get one thing: unpredictable. The future becomes a fog. And if our number one rule, our whole standard, is predictability, well, then the verdict from this analysis is simple. It's a fail. So let's just be crystal clear on why it fails the test. 1, a 20% earnings surprise is pretty much the definition of unpredictable. That's not a toll bridge, that's a roller coaster. 2, when half your entire customer base is staring down an unprofitable year, the odds of more credit problems are just sky high. And all of this boils down to one simple human thing. The certainty you need to own a stock and sleep soundly at night, it's just gone. An 8.5 PE on earnings you can't predict isn't a bargain. It's a gamble. And all of this leaves us with a question that's way bigger than just Farmer Mac. It's a question you have to ask yourself with any investment you look at. What is the real difference between something that's genuinely cheap and a value trap that's just waiting to snap shut? Because figuring that out, well, that's everything.